The decline in the equity market is getting steeper and steeper. The peak to trough decline of the S&P is now down just over 10%. So glad to be joined by Aahan Menon of Prometheus Macro. In my view, he's one of the world's best at systematic and quantitative macro. His clients are some of the biggest hedge funds in the world, so I'm really glad he is here. Aahan, welcome to Monetary Matters for the first time.
Hey, Jack, great to be on. Congratulations on the new show and the new business. You guys are crushing it so far. So big congratulations.
Thank you very much. Aahan, as I said at the beginning, the market is going down and it just seems like it wants to go lower and lower. How are you thinking about the stock market, about tariffs, and about all the other asset classes and how they fit in your quantitative framework?
Definitely a lot going on. As of right now, the way we're kind of seeing this is it looks to be a relatively localized positioning kind of unwind as opposed to something that's very fundamentally oriented or fundamentally driven. So the way we're seeing positioning right now is most of the sell-off is occurring in equities, which is translating into a bid for bonds. But relative to those two things, you actually aren't seeing commodity markets complying. So if you were having a major economic event, you would actually have commodity markets coming down precipitously alongside equities. And to us, that's kind of a sign that perhaps there's a little bit more around the news flow and geopolitics than there is around some type of deep-seated economic downturn. So that's the way we're seeing it. These things can move pretty fast, but at this point in time, it doesn't look like it's something very significant.
Not very significant. Okay. And another way to put that, Aahan, is what you write in Prometheus Macro, quote, the speed of this unwind has not been due to macroeconomic factors, but rather a combination of geopolitics and positioning, end quote. I interpret that as tariffs, tariffs, tariffs. The secretary, Howard Lutnick, going on CNBC and talking about tariffs. Trump tweeting from X or tweeting from Truth Social about tariffs, about how we're going to increase tariffs on French champagne from 100% to 200% and very high tariffs. And that is what I interpret. So you think that that is not a fundamental macroeconomic signal, but let's dig into that, because I feel like when you say fundamental macro, what you're picking up, you and your quantitative models are saying, oh, initial claims was weak, PPI was weak, CPI was weak. So that to you would be a macro driver. But if tariffs are coming, wouldn't that cause a decline in real growth that isn't picked up in the hard data? So in other words, what you're saying is that the decline hasn't been picked up in the hard data yet, but maybe stock markets are pricing that in, whether or not that it ultimately, the slowdown will happen.
I think the way we would frame it is that equity markets are pricing the possibility of that happening. And a lot of that also is around, it's kind of around this phenomena of, talking to clients. The main concern is the positioning of other players in the market unwinding. It's the amount of volatility we're getting from geopolitics and news flow is extremely high. As a result, what we're hearing from clients is that we're basically a lot of caution developing around everyone else's positioning, as opposed to the tariffs are going to turn into a very meaningful economic impact. With regards to the actual impact of tariffs, we've done some work on this. I think the big thing to kind of focus on is what is the maximum possible impact that we can have from tariffs on the economy. So the way we look at it is that tariffs, unless there's some type of really big reflexive loop, tariffs at their onset and even for subsequent months and even possibly years don't necessarily impact nominal GDP, but they can impact the composition of nominal GDP, so the balance between real and inflation. And the concern, I think, for most people is that these tariffs are going to create a negative profit environment, or a drain on consumers in some way, which is going to have a deleterious impact on activity over time, and activity as defined in terms of real output. I think that those are the concerns, right? But when we actually go and peel back the data, how does that actually work and how does it flow through the economy? The place where you would see tariffs pop up is in federal custom duties. Federal custom duties are basically the line item where tariff revenues pop up. Today, I believe the tariff revenues and custom duties in general maybe account for about $80 billion of tariffs. Now, I think what you want to try and understand is, one, how do tariffs typically over time impact corporate profitability? So I'll give you the takeaway. They are so small as a share of total activity that they have no meaningful impact. Now, yeah, and that's the visual. So the blue line shows total corporate profits. We've taken the tariff impact on profits, so that's the contribution to profits, or rather the detraction from profits. And what you can see is that that red line has virtually no impact. Now, I think something that's on everyone's minds is that, oh wait, we've not had any tariffs recently, so of course they have no impact. So what we did as a experiment and a stress test is we actually just scaled up the tariffs, right, by 10x. And we're after scaling up tariffs to 10 times their current levels, which are almost impossible, you would have virtually no impact on the profit cycle. So I think there are a lot of people doing a lot of great work around the impact of tariffs. They're taking into account all kinds of non-linearities and things like that. But as you know, the world I come from is systematic macro. What we're trying to do is we're trying to find consistent, durable, time-tested signals that explain macroeconomic cycles over time. And when we take a step back and look at what's going to happen over the next year, what's going to happen over the next 6 months to the economy, which is not always the exact same as the market, we just don't see that as being the meaningful driver.
So you don't think tariffs will be that big of a deal? Okay. And so I do think that is a fair criticism, though, of the chart. Of like, your chart goes back to the 1960s. The tariffs on total imports from 1960 until now were well below 10%. For 1960, they're about around 8%. Now they're at 2%, 3%. Like, if if he's speaking so kindly about President McKinley, what were the tariffs rate there? 30%. And on total imports, duty-bill imports on 50%, because some things were exempt. And I don't think Trump is going to take tariffs up to 50%. But if it's only a small decline, like, oh, corporate profits are only going to go down by 15%. As you know, Aahan, that's huge, because
Mm-hmm.
the markets are currently pricing earnings to grow at 12%. And if now they decline, or even to grow less, as earnings expectations go down, the stock market should go down too. So I'm not some massive bear thinking that this is going to be the Great Depression at all. But as earnings expectations decline, so should markets. I know actually the official earnings expectations posted by the big banks haven't gone down yet. But if
Mm-hmm.
the stock market continues to sell off, I'm quite confident that those earnings expectations will start to go down as well.
Yeah, and that's one of the most reliable relationships in the world, right? Like, as equities begin to decline, earnings expectations will decline, because a big part of analysts' expectations are actually just guided by what's happening to markets. But I think that the really important thing to recognize over there is that if you're trying to take a comprehensive approach to macro, like what we're trying to do, what's happening to markets is one dimension of it. What's happening to the economy is another dimension of it. You have to combine both of them to get the whole picture. And so I think just benchmarking to what's happening to equity prices and extrapolating that to what's going to happen to the economy, and extrapolating that further into your investment views, like, I don't think that that's the best way to think about this. I think that you have to take ample amounts of signal from what markets are doing. Absolutely. Like, we do that on a daily basis. But I think recognizing what it is also really important. And I think that what we have today is not a massive economic concern, but rather a pricing in of uncertainty into equity markets, coming from a period where we had really, really elevated earnings expectations driving one of the strongest bull markets we've ever experienced. And so, when you put those two things together, you have really exuberant earnings expectations alongside just absolutely killer stocks. The Trump election, which had a further rally after that, only to be reversed with all of this economic kind of uncertainty around what the policy path is going to be, both on the fiscal and tariff side. You basically have a re-rating of those expectations. So I think it's a market-based thing. You should definitely. I don't think that, in no way, shape, or form am I saying be a hero, go long equity calls, like that. That's not what it is. But I think reconciling what near-term trend is telling you with what the macroeconomic fundamentals are telling you is a really important part of piecing together the picture today.
So the macro fundamentals are not having you very concerned, but when it looks
Mm-hmm.
at stock momentum, so in terms of, did stocks go down on Monday? Yes. Did they go down on Tuesday? Yes. Did they go down on Wednesday? Yes. You write that your momentum reading, a short-term momentum reading on the stock market is currently maximally negative at negative 100%. Tell us about that, and how much does that inform your macro view? Like, maybe you're maximally bearish on that one tiny little thing, but if it's your macro view has many different inputs, then you're not that bearish overall.
Exactly. And that's what it is, right? You definitely have to take some signal from momentum. Like, without a doubt, you have to take some signal from momentum. But the thing is that momentum by itself is not such a good thing. So what we've actually done to kind of visualize this is we've talked about, if you look back over, let's say, the last 6 months, and you take every possible look back definition of momentum. So 1 day, 2 day, 3 day, 5 day, 6 day, all the way to 260 trading days. And you combine that into a single estimate. That measure is now maximally negative, which is consistent with the price declines that we're seeing, right? So when you look at that, you immediately become a little bared up. And that's what everyone is today, and rightly so in some way, shape, or form. But the question is, can you actually trade that? Like, is that a valuable insight? And so what we found over time is that signal by itself is actually a very, very poor indicator of equity market conditions. And what actually ends up determining whether those signals are useful or not is whether the economy goes into a downturn. So if you look at periods where the equity market begins to fall, like it does today, and the economy also begins to show weakness, or it is already showing weakness, that's when you have the opportunity to get short stocks. So in the red line over here, you can basically see that if equity market momentum is negative and we were in a business cycle decline, you can get short stocks quite successfully, and the P&L profile would be really good if you were short those periods. But on the flip side, if you actually have equity momentum negative, but at the same time the economy is still expanding and you're still in a business cycle expansion, that's actually a buy the dip opportunity. And so if you were short the blue line, which is what we think you would be today, like without a change today, we think that yes, equity market momentum is negative and you should be pulling back on your exposure because vol has exploded. And that's a whole discussion. Like, how to manage risk is a whole discussion. But right now, if you go max short or you're short in whatever shape or form, we think that you're closer to the blue line than the red line.
And for our lovely listeners who are not watching this on YouTube, the blue line has gone up since 1970, and the red line has gone down since 1970. So, Aahan, it's a much more simplified version of saying that is that buying dips works when the economy is expanding, and shorting dips works when the economy is in a recession or contracting. You think the economy is still expanding, that we're not in a contraction. So you think we're in the blue line. So therefore, you think to sell or to short this decline in equities would be a mistake.
Yes. That is true. Now, the way we're also approaching it is that we want to be, look, every time you make a trade or you make an investment, what you're basically doing is you're basically saying, hey, what is my expected return and what is my expected risk, right? And that recognition is essential, right? So I think that equities are going to be higher, right? But at what level of risk? I think by any measure today, it is clearly that the risks around equities are elevated. Vol is elevated, like implied vol is elevated. Like every measure of risk, the drawdown is huge. Like every measure of risk that you could look at is basically elevated today. So what you want to do is say, do you expect equities to power ahead like they did in 2024? No, I don't expect that. I don't think that's a reasonable thing to expect. I think that in any year, it's pretty unreasonable to expect equities to do that. But do we expect them to be positive? Yeah, modestly. We expect them to be more consistent, probably a little bit less than their average annualized returns over time. But what we do also see is that vol has come up massively. So like, be long, that's the way we're approaching it. Like we think that being long makes sense, but being long in much smaller size than you would have been going into the year. Like that's the way we think it makes a lot more sense to kind of put together the picture.
And that is what you've got to do if you're a short-term trader, if you're a long-term investor, which I recommend people do, you don't have to care about this at all. But if you are a short-term trader, you have to and you should de-risk as volatility increases, because if volatility goes from 10 to 20, your risk has increased by 2. So if to have the same risk, you've got to have your position sizing. What has volatility, Aahan, actually done? And here I'm going to nerd out. So for like non-quantitative people, just please stay with us. But like, I feel like everyone says the market is super volatile. Yes,
Mhm.
it's a 10% peak to trough decline in the S&P,
Mhm.
but it's been a thousand little paper cuts, a little 80 basis point decline on Monday, a little 90 basis point decline on Tuesday. There hasn't been one huge flush downwards. I think on Monday maybe the S&P was down 2.5 or more than that,
Mhm.
but really
Mhm.
you realize volatility if you measure it based off of one day, close to close volatility has not been that high. So, but I know there are many other ways to measure volatility, and of course the VIX, which is implied volatility, not realized volatility over the next 30 days, has gone up, but it hasn't gone up that much because realized volatility close to close hasn't gone up that much. But also there's huge intraday swings. And Aahan, based off, you basically gave me an idea that I have said on the show several times, which is that trend is not going to perform very well. Like Trump
Mhm.
tweets something at 9 a.m. at 2 p.m. he totally reverses it, and the market just has these epic reversals intraday, and yet the overall trend seems to be down. So how are you thinking
Mhm.
about this market in terms of, we already talked about momentum, but in terms of volatility and in terms of trend?
So start at the top. It this classification of volatility just depends on like what type of look back you're using. So like if you use if the shorter the look back to calculate your vol, the higher the reading you're going to get. So if you take the last 20 trading days, which is like 1 month, which is basically like the realized version of the VIX, right? VIX is implied. That number is popped up to 15 from 10. That's a pretty big jump, right? Like that's a pretty big jump by that measure. But if you zoom out a little bit, 6 months and things like that, yeah, you're in the 10 to 15 range on equity vol. Now there are other measures of risk, like I promise we're going to stop talking about stat stuff right now. But the other ways to talk about risk, which are things like semi-variance, which is basically downside vol, those measures are even more elevated. Now, I think what you're basically looking at when you look at vol is like you're looking at the epic amount of uncertainty that is coming out of this administration, right? Like you're just entirely unsure, and it's also more complicated by the fact that you have uncertainty around the path of the Fed. So between the Fed and the current administration, you're really, really unsure about what the implied policy path is going to be, and as a result, investors across the board are just generally much more concerned, much more ready to buy protection, and much more ready to de-risk the equities, which in itself, when investors do that in aggregate, is vol inducing. So you're just in an environment where you're going to have more vol until there's a little, one of two things is going to happen. People are just going to get used to this, right? Like this is the new normal. Or you basically have a situation where the news flow begins to subside a little bit. We get a little bit more clarity on what's ahead. I expect a little bit more of the latter. Like what seems to make more sense is that from here we start, as the economic data continues to come in over the next 3 months, 6 months, 1 year, in the event that we don't have just tariffs killing the economy or fiscal pullback killing the economy, I think that you're basically going to have a realization across the board where, oh wait, this is not that bad. So and people start adding back exposure over time. Now it's entirely true. The alternative scenario could also happen, right? Like where you have a situation where equity markets end up declining massively to the extent that they actually have an impact through the wealth effect on consumption and this, that, whatnot. And that creates a downward spiral. Businesses become more underconfident because of the equity market selling off so much. So they stop investing, and that has a whole bunch of effects. That's entirely possible. But I think a 1 month decline does not get you to that point. Right, like that. I think that's the main takeaway. Like a 1 month decline doesn't get you to that point where you can basically have this downward self-reinforcing spiral, because there's a whole real economy that supports spending that is not only contingent upon the equity market.
Yes, and it really is in a way pathetic, Alhan. We are, when I read this a few days ago, 7% off the highs of the S&P. I was already seeing articles on Bloomberg about how wealthy people are making plans to pull back on their spending. And it's like, I think we should have an economy that our people spend money because they earn money from going to work, and then they spend the money. Okay, they can borrow some money, but buy houses. But like, people shouldn't, it shouldn't only be rich people spending money because the stock market has gone up so much. But I think once you get to start to, okay, S&P is down 20%, it's continuing to go down, a 30% decline. The credit market's starting to blow out. Sales, are sales selling begets selling, and you have a volatility spiral. Then I think, yeah, that you really do have a wealth effect. I guess. What do you think of Trump put? If the credit spreads blowout from 300 basis points to 600 basis points. Yeah, yes, the Federal Reserve will get involved and cut interest rates. In my view,
Mhm.
there is a point, whether it's 600 basis points or higher or lower. But what about the Trump put? Wall Street was very confident. Okay, the Treasury Secretary Scott Bessent, the Commerce Secretary Howard Lutnick, both come from Wall Street. They're going to be paying attention to Wall Street. It doesn't seem to me like Trump is perturbed at all, President Trump, about
Mhm.
the decline in the stock market. And when Lutnick and Bessent are interviewed, they don't seem terribly concerned either, saying volatility is natural, it's part of the business cycle. This is going to be a detox period. I think just the stock market could continue to go down on rumors of tariffs, and then maybe when the tariffs are announced, they won't be that bad, and then we get the stock market begins to boom once again. Like that's what happened in 2018. The stock market did
Mhm.
great under Trump 1.0, excluding COVID, of course. But then it did have some volatility in the Q4 of 2018. So I'm not a long term bear by any means. I think this market probably is more likely to go lower than higher. And I agree with you. I just don't think there's a lot of short term upside. But of course, like I don't want that to dissuade people from being long term investors in the American stock market, which I think is a huge
Mhm.
wealth creation vehicle. But
Yeah.
sorry, go ahead.
Yeah, I think it's a continuum, right? Like I don't think I don't think it's a binary event that like I don't think there's a binary definition of whether the administration cares about stocks or not. Like I don't think that that's how it works, right? Like so, do they care about a 10% drawdown in a month? Probably not. Do they care about a 40% drawdown over the next 6 months? I have a feeling that's going to so from a a more quantitative perspective, like one of the best indicators of whether you're going to get an easing cycle is a vicious drawdown in equity markets. Now that drawdown in equity markets needs to be accompanied by economic pain as well, because that impacts employment and whatnot. But one of the best indicators of whether they're actually going to ease policy is whether you have a really significant drawdown in equity markets. So I think that when push comes to shove, the Fed and fiscal authorities in general, they do have to they have to manage for employment, and if equity prices are down to the extent that they're actually dissuading businesses from investing, which is hurting their profits, which is hurting their hiring plans and such, that is an event that they're going to have to manage. I will say that there is a very very strong push for fiscal conservatism, much more so in this administration than I think anybody would have expected, and that definitely is something that is marginally impactful. Like it does create like a Trump put on bonds, right? I think that the difficulty with that though is that the sheer volume of interest payments that we have and the existing amount of non-discretionary spending that the government has to do is really hard to cut back on. And so yeah, like are they going to increase discretionary spending in a dramatic way, which is more inflationary and going to continue to push yields higher? That looks a lot less likely today, which definitely puts a little bit more of a cap on yields as compared to previously. But at the same time, I think that a lot of the dynamics that we're with today have built up over the last two financial crises, like between the COVID crisis and the great financial crisis, to create a situation where government debt is such a large part of the economy, where it's going to be hard to really walk that back very meaningfully. And I think a lot of the news flow around this is also just misleading. Like the proposed amounts of cuts are usually over a decade, or over 5 years or 10 years or whatever, and that is it's marginally impacting the outlook when it comes to bonds as well. But I think that when you really kind of look at it, we do have a little bit more of a situation where the Treasury and fiscal authorities are a little bit concerned about the size of the deficit. They want to bring it down. That is modestly, incrementally more supportive of fixed income than previously. Yeah.
So, talk to me about the monetary transmission mechanism of the Federal Reserve interest rate policy. You've got some great charts on the private sector interest rate burden, which, as the Federal Reserve raises interest rates, that draws money out of corporate profits and the private sector. But then also the how much the Treasury is paying the private sector in interest, because the private sector owns the bonds of the U.S. government, the Treasury. So we can
Mhm.
flash that chart up, and just can you explain why has the Federal Reserve going from 0% to 5.5% and now in the 4%? Why did that not cause a recession?
Yeah, definitely. I think that's a really big part of what's happened till today, and it's also going to be one of those things that makes monetary policy a lot harder to enact. So how does interest rate policy get into the economy? It gets into the economy, but in two different ways. It hinders people from borrowing more money, and it also over time increases it increases interest burdens on existing debt that's being rolled over, right? And so as the Fed hikes interest rate policy, these interest burdens tend to rise. But what you also have, which has always existed, this is not a new thing, this has always existed, is that every treasury asset that's not owned by the Fed and not owned by the foreign sector is owned by the US private sector. And those assets create income. Now, the impact of monetary policy depends on the mix of the private sector, of how much treasury securities they own versus how many private sector securities they own. And so when policy rates are hiked, the owners of treasuries receive income, and that increase in income, the interest income, offsets any of the increase in interest expense. And so as a result, over the last few years, because you just had such an explosion in treasury securities in the private sector, you basically have a situation where the hikes have actually created a net interest benefit to the private sector. So what we've shown over here is basically how the private policy rates have typically just translated linearly into an increased interest burden for the private sector. But today, you're basically having a situation where policy rates have had almost no effect on the net interest burden of the private sector. And in fact, because of the amount of interest income that treasuries are spitting off today into the private sector, they've actually been mildly stimulative. And so the difficulty in this kind of backdrop is that you basically have a situation where the amount of debt is not likely to decline very meaningfully. And at the same time, you basically have, for every unit of debt, you have a modest amount of stimulus going into the economy. And that basically neutralizes the effectiveness of the Fed in very sharply curtailing economic activity.
So high interest rates haven't been that restrictive, but eventually they must become restrictive, right?
It depends on two things, right? It depends on the balance of how many treasuries do I own versus what are my liabilities, right? And what is the relative duration of those two things, right? So if I own short-term treasury securities, I roll those securities over relatively quickly, right? If I own bills, they roll over every 3 months or whatever. So if the Fed hikes policy rates, that benefit immediately goes to the asset holder. But if I owe a 30-year bond, I owe a 30-year mortgage, right? Like I have to pay out a 30-year mortgage. I have a 30-year mortgage. That interest, that the effect of interest rate hikes, it's not going to affect me until I choose to refinance my mortgage, if ever.
Right.
And so what it depends on is like, what is the mix of assets and how is that going to flow through to the economy? In today's environment, you basically have a situation where, yeah, you do have some amount of refinancing happening slowly when it comes to the liabilities of the private sector. But the benefit from the short-term securities created by the Treasury are so large, it's just like completely offsetting it right now.
So the government debt is huge, and as a result, interest rate hikes and the higher interest rates are not as contractionary. You say, obviously, I put a lot of respect into what you say, but you say that actually is net stimulative. I don't know if I'm ready to like go that far, because that will just bend my mind too much. But yeah, that's crazy.
It's net stimulative on a rate of change basis, right? Like it's not net, like private sector net interest burden is positive. It's not like, oh yeah, like we're only getting paid. It's just that, so if you think about earlier, when I would raise policy rates 5%, so from 0 to 5%, I raised Fed funds rate, that would result in interest burden going from 0 to 5%, right, for the private sector. Today, what we're seeing is actually the opposite happened in terms of direction. So it's stimulative in terms of direction. That doesn't mean that like we're not paying any interest rates at all in the economy. That's not true at all.
Got it. Thanks for lining that up. And also, I'm just seeing from Bloomberg today that the S&P 500 is officially in correction over 10%, and it's the seventh fastest going into correction since 1929. So that sounds a little bit ominous. So yeah, just we're not throwing around, we're not trying to fearmonger, but we're just trying to report accurately that people are concerned, and that's reflected in the market. Aahan, we talked about the fundamental macro. What is your fundamental macro view based off of the panoply of data? What are you expecting inflation, GDP, spending, and real GDP, real growth to be in 2025? How does that compare to other blue chip economic forecasters at the big banks, at the Atlanta Fed, and others?
Yeah. So I think there's been a lot of consternation, particularly around Atlanta Fed popular GDP nowcast models. So for those that are not super, like don't have their nose on the data and aren't looking at Atlanta Fed all the time, Atlanta Fed is a really popular GDP nowcast measure. You can just go on their website and they update GDP data based on their GDP estimate, based on all the data that's coming in. It's a very nice model, really convenient. It's quickly become extremely popular. Those readings slipped into deeply negative territory, I would say, about a week ago. And that was after the original cracks in the S&P 500 began to show. And people became really concerned that, oh my gosh, did the equity market sniff out like the next recession? For technical reasons that aren't super complicated, honestly, those readings are kind of off. Basically, the way Atlanta Fed calculates the import and export is consistent with anybody responsible that's trying to calculate import and export data. They take so total trade data comes out a little bit late in the month. Prior to total trade data, you get the goods trade balance. Now, the way the BEA accounts for trade data is different from the way the first release is actually reported. And so what is basically accounted for is gold imports, which should technically be in the capital account. They should be in the capital account. They will not actually go into the GDP numbers. But what ended up happening is because of the differences between these two reports, you ended up having the gold imports go into the GDP nowcast, and gold imports were just up a phenomenal and spectacular amount, which resulted in the GDP nowcast coming down. So, like, is that a recession signal? Like, absolutely not. We, on our end, like, our programmatic estimates are basically just looking through that almost entirely. So, even if you if you strip out basically the trade components and you focus only on the real GDP components, domestic real GDP components, you have like two parts of the economy that really, really matter. And there's the third. So the two parts are what is happening with domestic investment and then what's happening with domestic consumption. Those are the big pieces. Government spending does matter somewhat, but it's just not as meaningfully impactful to total growth conditions.
Right. And Aahan, sorry. So GDP is consumption, investment, government spending, and then net exports. So exports minus imports. So the more that the US imports, that the greater the negative that draws down GDP. And in January and December, the US imported a ton of stuff because people were front running tariffs. And this can be seen in the data, but in particular, they did a ton of importing of gold from London, from Switzerland. So for example, US gold imports in, like, let's say May 2024, or a normal month during 2024, were like $4 or $5 billion. They were $30 billion or $34 billion in January. So people were front running tariffs because they thought there'd be a tariff. So it is a kind of mechanical thing. Like, I don't think that the real economy will be affected because we are importing so much gold from Britain because metal arbitrageurs are wanting to front run tariffs. Like, I don't think it's that bad. So, for example, This is from the LinkedIn post from the Atlanta Fed now. Let me just see if I can find it. So the Atlanta Fed GDP now that looked so bearish last week was negative 2.8% growth for the first quarter, but adjusting for gold, they now have that at 0.4% real growth. But it sounds like your expectations for growth are maybe even higher than that.
So I think even we basically had it at like 0.5. Like that's basically we had it about 0.5. Now, I think when we zoom in to what we think is going to happen to these GDP numbers over time is, one, like, you can completely ignore this trade data. Like, don't worry about it. It's not indicative of US conditions. Two, I think when we try to peer into the future to understand what the likely path is, we basically see two like pretty opposing forces operating at the same time, which is that you have just like a buoyant consumer. So consumer spending is just epically strong in the United States. We track 16 subsectors, and then within the subsectors, you can basically disaggregate to about 90 sectors and or 90 subsectors, right? 100% of those components are expanding over the last year. And so if we were to have a really meaningful downturn in the economy, that would be the first time on record that's ever happened. I know there are a lot of people that are like into this whole leading lagging indicator thing and whatnot, and that the response I get often is that consumption is like a lagging indicator. But within consumption, you have lots of items that are also considered leading indicators, things like automobiles and whatnot. And all of those items are actually seeing expanding consumption. So that part looks pretty robust. When we go to investment spending in the economy today, you basically have a situation where residential spending has begun to deteriorate and inventories have begun to slow down a little bit. Like inventory accumulation has begun to slow down. I think the inventory part you don't really have to worry about, because inventories are one of the most reliably mean reverting and cyclical things in the economy. And so basically, if you have inventories up today, you're probably going to have inventories actually down tomorrow. So like if they're down today, they're going to be up tomorrow. And so that is just a function of the fact of the way they're created, and you're basically just going to have like cyclicality in that component. So don't need to worry about that too much. The residential construction component is slightly worrisome. Like that's definitely something you start to see activity fall off there. Permit starts, completions, sales, all of these things have begun to weaken. That being said, employment in the sector remains really, really healthy and strong. Now, if I add up what's happening in consumption and I add up what's happening in investment, I think that we're basically seeing a situation where investment is maybe a little bit weaker, but consumption is really just enough to power the economy along almost entirely. So synthesizing that, like our expectation right now so we have these month-on-month programmatic numbers that are spit out every month for next month's GDP. So our annualized forecast for GDP right now is 2.5, like 2.5%. I personally think that's a little bit rich to like what we might actually get over the course of a year. We just extrapolate the monthly numbers over the next year. But at the current junction, the strength of the consumer is so immense. And the weakness that I described in residential investment is the only part of the investment complex that's actually meaningfully weak. If we go to intellectual property investment, it's at all-time highs in terms of growth contribution. If we look at information investment, information equipment investment, it's expanding. Transportation equipment is expanding. Industrial equipment is expanding. And these are all the major areas of business investment, and they are actually marginally getting better. So I think this kind of brings up like a little pet peeve of mine with I think that there's a massive focus in the macro community on housing, right? Like housing is the business cycle. Like there was a paper written by Ed Limo a few years ago where he basically showed how most of the variation in the business cycle can actually emanate from housing. But that paper was written, I don't want to butcher the date, but
during a housing bubble, 2003. Yeah.
So it was written in 2003, and the economy has meaningfully changed over that period of time, right? And so what you've had is just like a huge proliferation of intellectual property investment over time and information equipment investment. And so like those factors, both to equity markets and the economy, matter way more than they ever did in past cycles. So like we actually make indexes and indicators and whatnot out of these things. And what we found is that like over benchmarking just to the weakness in housing can quantifiably lead to worse investment outcomes in the equity market than using a broad-based understanding of what's happening to the business cycle. And so I know a little bit long-winded, but just getting back to the point, we think that growth is probably going to, like the current trajectory looks really bad. There are some technical issues making that look really bad. We think that it's probably going to bounce and get back to a more stable kind of expanding area.
And I'm looking at a chart of the difference between the Prometheus nowcast and the Prometheus forecast. The Prometheus forecast expects real growth to go up a lot, whereas the blue line, we could put this up shortly, expects it to decline. Can you explain this difference?
Yeah, for sure. So this is a very simple difference, right? So the forecast is basically taking leading data, some other lagging data, and all of that, and combining it to say what is it that we actually expect GDP growth to look like, right? So skipping over the trade and all that stuff, if we look at the business cycle drivers of the economy, reconcile that with what's happening to the labor market, consumer, all of that, that's how we get to our Prometheus forecast. Like that's the actual view. The nowcast, the current trajectory, the blue line that's heading downwards very significantly, just extrapolates the most recent trend in the data. And so I think that what this allows, the reason we show this visual is basically most people are just benchmarked to the momentum of what's happening to the most recent data. And what we're trying to visualize is, okay, like, can we have a view that's different from what just happened to the latest GDP nowcast numbers over the last 3 months or 6 months? And that's the difference.
And so how much of that difference is just the gold imports is messing with the data, or are there other quirks?
A huge part of it, like probably 70-80% of that is just the gold stuff messing up what's happening with the data.
Right. So if people see on Twitter or see elsewhere this chart from the Atlanta Fed showing this huge decline in the economy, that is because of all the gold coming out of Europe front running tariffs, and it's not economically sensitive. So I'm not saying that real growth won't decline or be bad or but that forecast from the Atlanta Fed is having that adjustment. So you got to keep that in mind. Okay. So tell us, how has consumption been strong? I know the previous data in 2022, 2023, 2024, it was strong, but I wasn't aware that it was getting even stronger. I thought that the rate of growth was going up from, the rate of growth, it was 8%, then 7%, 6%, 5%. And admittedly, maybe inflation was going down by more. So real spending actually went up. The growth rate went up. But tell us, you're saying that the breadth continued to go big. And then also, what, if any, attention are you paying to the news flow from Walmart, Target are warning, and they're leading their economic profit outlook lower? I know, Aahan, over the past 3 years, there have been tons of scares about the consumer is actually weak based on what Walmart said, and 0% of it ended up anywhere. It was all fake. But do you think this kind of time could be different because of tariffs?
Probably not because of tariffs, but I think the main thing is what you described is totally right. That the consumer is, you have had a declining rate of change of growth of consumer spending. That's true. The dynamic I was describing was the breadth of whether that consumer spending is positive or negative. And so one of the defining characteristics of whether you go into a recession or not is that GDP breadth, which includes consumption. Consumption is a subset of that. If you look across all the items that go into GDP, we tally about 75. If you look across all those items, basically what you'll start to see is a bunch of them will start to get more and more negative on a quarter over quarter, 6 month, and year over year basis. And so part of that, it's basically just indicative of like how strong are macro conditions on a broad-based basis, right? And what you need is, for you to have a recession or a big downturn, you have to have really strong weakness in one area of the economy and middling kind of performance in other areas of the economy. So if you look at every past recession, it wasn't that personal consumption expenditures breadth was at zero. That doesn't happen. But what does happen is that interest rate sensitive items like durable goods consumption and stuff like that, they do come down. So maybe you get 50% breadth or something like that in personal consumption expenditures. But you have a place like housing that implodes, or industrial equipment implodes, or transportation implodes, or something like that. And the thing that you have to think about when you have to think about a recession is that aggregate activity has to decline, right? And for aggregate activity to decline, something has to be really bad and something has to be like okay. Today, you have a situation where investment is okay, it's being weighed on by one sector, and consumption is really strong. So if I have a situation where consumption is contributing 2.5% to real GDP growth on a year-over-year basis, to get to a -1 real GDP reading, I have to have a 3.5% negative investment growth. So it's about doing that math and saying, like, what are the offsetting factors? And when you look at that, the breadth of consumer spending, like the strength of consumer spending today, is like, it's just inconsistent with anything we've seen. We just have to have crazy weak, just absolutely ridiculously weak investment numbers with this kind of consumer spending.
And Aahan, So President Trump has announced a lot of investments into the United States from
Mm-hmm.
Apple investing 500 billion into the United States. I mean, that's definitely not going to invest $500 billion this year. I think it will be over a longer period of time. Some of it may be that they repatriate capital. How do you think that will impact the actual on paper investment in domestic US GDP investment? Because right now, like, I think foreigners are selling their stocks and they're pulling money out of the country, but that's not
Mm-hmm.
reflected in GDP. But if they put their
Mm-hmm.
money back into it through foreign direct investment, or Apple invests, and actually building plants and stuff, that will be reflected in positive GDP. So, how will that impact the national accounts going forward?
Yeah, I think on that front. So first off, just like the fiscal stuff, you gotta take a massive haircut on anything that's announced in the news flow, right? So I think first off, massive haircut. Second, like if we do actually get a massive flow inwards in terms of FDI and whatnot, if it's particularly in the tech sector, like that is going to be really, really meaningful and a very, very strong driver of activity. The last time we actually saw a really, really meaningful change in investment policy based on federal policy was when we actually had the CHIPS Act, right? Like where we basically we encouraged the production and investment in production facilities in the United States, and that led to the single biggest manufacturing investment boom that we've seen in the construction sector. And so we're still getting the benefits of that because those projects are still ongoing and they're still actually supporting non-residential investment. So residential investment is pretty weak today, but non-residential investment is still really, really strong. At one point, non-residential investment spending was up 77% in a year. Sorry, for manufacturing was up 77% in 1 year. So, I mean, if we ever have anything of that magnitude, it completely changes the game. And my expectation is that like most of these things are going to be more bluster than actual meaningful change. But if they do, like they would definitely meaningfully increase investment in the economy. Now, the place that actually needs it the most, like I've been describing, is the residential investment sector, and I don't think that that's a place where it's really going to go. So if you're watching for weakness in the economy, that's the place I would be looking the most. Like that's where the activity is declining. That's where profits are starting to become squeezed. That's where you have the potential for layoffs. And so if there's any piece of the economy where you're looking for like, hey, what leads to the downturn, which allows you to express it well in markets, it's going to be in the residential investment sector.
Okay, you're saying residential investment is already not very strong, so that is the one thing
Mm-hmm.
that could get weak. But consumption
Mm-hmm.
is very strong. I understand that, but tariffs could knock that not down to not very strong, and then to weak. Like if there's a 200% tariff on champagnes, I think yes, that will stimulate consumption of domestic wine, clean wine in the United States. But there
Mm-hmm.
probably will be some snobs who say, "I want my champagne from Champagne, region of France," and
Mm-hmm.
I think consumption will go down. So I think consumption could weaken as well, maybe.
I mean, so here's the thing, right? So the nominal spending is unlikely to change, right? The nominal spending is unlikely to change. It's how much of the stuff that you're going to get is going to change. So why do the tariffs matter, and how do they end up really majorly impacting the economy? You end up buying less stuff for the same prices, which ends up actually being a drag on profits, right? Like that's the way it ends up flowing. And so I think the main thing to think about when it comes to those tariffs is like what is their actual size going to be? So in the example that I showed, we scaled up the tariff revenues, which are what eat up the corporate profit share, by 10 times. And
In your
so
model, yeah.
yeah. And so like yeah, you're talking about a 25% increase. I'm talking about what is that, 1,000% increase, right? And so even with 1,000% increase, the drag on profits is just not enough. Now, all of this being said, like Jack, like let's also couch all of this like with where I'm coming from and who I am, right? My job is to find what are the things that are going to work over the next decade for both retail and institutional investors that they can trade on like consistently over time. There are plenty of experts who are really, really good at going through every line item of the data and coming up with exactly what the estimates they think. But what I'm basically capturing is the fact that there is no way for you to validate whether an estimate of tariff impact is going to be good or bad. Like there is no way. You have maybe the onset of tariffs, like big spike in tariffs, maybe 3 times in U.S. history. So the way we approach it is to say, does this meaningfully change economic dynamics? Like, does it meaningfully change economic dynamics, and does it help us understand history better? And from that perspective, it just doesn't make sense to us because it's not anything repeatable. It's not something that is actually, by these measures that we've constructed, like something that is super, it's not super impactful by all historical measures. And so, like, when we look forward, what we're going to focus on is the things that we think are going to meaningfully impact the cycle. But, there is ample room to be wrong, right? We had long equity positions going into this month, and we've had to pare them back because the news flow from tariffs has been very dramatically impactful. I continue to think that the actual effect on the economy is not going to be that impactful, which will result in more of mean reversion in equity indices as opposed to just a breakdown in trend and a bear market. So it's coming from a programmatic, systematic kind of place, as opposed to me doing the math on this, like what is a specific tariff and what is the impact of a specific tariff on this and that sector.
And so you think that there will be mean reversion, meaning that if for the past 2 weeks stocks went down, over the past next 2 weeks stocks could go up. Tell us about your views on mean reversion, and then also how really in fundamental in trading and in quantitative macro there really are only two forces: trend following and mean reversion, and the marriage between those two opposite forces.
Yeah, absolutely. I think that this is one of the things that we spend a lot of time focusing on, right? I think that trend following is, for a lot of reasons, mostly because of accessibility, just like super obvious, right? Like if markets are going down today, like I'm going to go short the market. And what we find is that approach used to be very, very successful. Like a lot, maybe from, let's say, the 50s to maybe the 80s. But as markets have developed and people have traded and alpha has been eroded, you basically had a situation where the edges created by trading such trends has basically disappeared. Right? Like if markets went down yesterday, there's a higher probability that it'll go up to tomorrow, today, than there is they'll continue to go down. And so, like when you're looking at markets today, you're basically looking at a situation where there isn't like an ensemble of things that's telling you like, hey, I should go short. There is one thing very dramatically telling you you should go short, and that thing is not very, very successful in the modern era, and that thing being trend. When we look at mean reversion, alternatively, what we see is that equity markets today have become much more mean reversion mechanisms than they have trend following mechanisms. And as a result, like it allows you to capture moves like this way better, right? So if we're looking at a situation today where the economy, let's say we're 6 months from now, right, and the economy ended up doing fine, that we think there's a much higher probability that equity markets will bounce off their 10% low, then they will continue to break for no reason, right? And so like that's really the way we think about it, right? Like you have to have a combination of mean reversion and trend in your approach. Like you can't do one or the other. Now, if you have a mandate to do one, that's your job, right? But I think what I've seen become really, really commonplace today is to do only one and to do it in one market, right? Like to be a trend follower and just in like ES, right? Like things like that. These are
Yes, stock futures.
S&P 500, or just to be a trend follower in bonds, or maybe just to be a trend follower in like 2 or 3 assets. That approach is not something that's going to be durable, and not something that we think is really going to make sense in this environment, because like there is not much history there to support its durability. And at the same time, like we just don't see the actual reasons that it has to, like the only reason that the trend needs to persist today is that the trend exists. Barring that, like unless you have a very meaningful and well thought out view, which there are plenty of intelligent individuals that have opposing views to mine, and that is totally fair game. If you expect the economy to meaningfully deteriorate from here in a way that can actually be seen in actual macro data, payrolls, claims, housing data, all of that stuff, if you have an actual view that, hey, that thing is going to go down, it's a great bet to have the trend following trade on. Mm-hmm. But we don't have that expectation. And so we have the other side of it on.
Do you think DOGE will reduce federal employment by a way that will substantially impact the payrolls? Federal employment declined by 10,000 in the jobs report that was released in early March, about February, but it probably is going to go down way more in the March data that will be released in early April, right?
Mm-hmm. Yeah, I mean, and I think that that's definitely like it's that is see relative to tariffs, that is a way more meaningful risk.
Okay,
I
yeah.
think that is something to definitely be concerned about, to monitor really carefully. I'm not I'm not fully aware of the scale that we're going to actually achieve. I don't think anybody really is, to be honest. But I think the impact of downsizing government employment would have a really big drag on total non-farm payrolls, which would in turn, those are the types of things that actually create the vulnerability for things like housing that are getting bad to turn you into a recession, right? So like you could easily imagine a situation where we have a ton of government employees laid off. That doesn't result in the recession in itself. What that does is it brings down growth rates to a point where they start to become vulnerable to a recession. And so I think when I'm thinking about what's happening to government payrolls and such, it's much more about that sort of perspective. Can they marginally decrease us and increase our vulnerabilities to future recession, as opposed to like they're going to be the cause of recession imminently?
And what do you think about bonds and commodities?
So bonds, I think I've outlined structurally like why we think that the monetary policy transmission of the Fed is limited in terms of being deleterious to activity. Like the Fed is just not as effective as it used to be in past cycles. That's definitely one part of it. The second part of it is like, what is activity relative to what the Fed is trying to do, right? So like what are interest rates? What are interest rates relative to activity? That's basically what determines how tight or how loose policy is. And so when we look at activity, yeah, activity has begun to slow a little bit, but at the same time, activity is still pretty like healthily above net interest burdens today. And so as a result, we don't think that they're super tight. Now, the thing that we've become like a little bit more concerned about is if you continue to have pockets of the economy weigh on total activity, you can start to see an environment where the Fed is actually restrictive, right? Like it's not that the tightening has done it; it's the fact that the new investment in the economy, yeah, is beginning to actually like slow down enough to be able to make the Fed restrictive. And so the Fed's policy hikes in themselves, not that big a deal, but now like the the added effect of having weaker residential investment and whatnot, that's where I think that's the real concern. So when we look at what the Fed may need to do in the future, we see some possibility that they may need to cut in the future. But when we aggregate all the data, right, like so all of it, which is basically labor data, sales data, inflation data, all of that, in a manner that's consistent with what the Fed tracks, like the Fed cares basically about two things. Like they basically care about the level of employment and the level of inflation, right? And there are a wide variety of gauges that you can use to come up with whether we are consistent with their objectives or not. When we add up all of those measures, we basically get to a point where the Fed should be at about neutral, right? Like there's no need for them to hike and there's no need for them to cut. Right now, there are about 75 basis points priced into the market, right? I haven't checked today. That may have moved quite dramatically. But as of yesterday, we had about 75 basis points of cuts priced in. Now, I think that we have just precipitous amounts of uncertainty, and all of this equity market downtrend feeds into bond market uptrend, right? And so the way we're looking at bonds is that like bonds are much more tradable today than they are investable, because if you really want to invest in bonds, what you want is you want a serious and prolonged cutting cycle, right? Like what you want is you want a situation where the Fed cuts between 4 and 8 times. Anything other than that is a trade on a growth scare, right? It's like, oh no, like equity markets are going down a lot, mechanically that's going to support bonds. But for us to achieve like a bond rally of yesteryear, you need to have a meaningful cutting cycle in excess of what's currently priced. That part we actually don't think is going to happen. So when it comes to bonds, the way we're looking at it is that bonds are protection for what's happening to equities. So like the way we've been allocating is we've been adding bonds as equities decline, but it's not for the purposes of like expecting a recession. It's like a correlation benefit.
Okay, that makes sense. And yeah, I just want to say you're a very quantitative person. So like their macro narratives are extremely abundant. Like the macro narrative that I actually do kind of believe now, and with a high enough conviction that I actually share it publicly, is like I think the stock market will go down, and I think that the Trump tariffs will cause real growth to go down, and the Federal Reserve
Mm.
probably will cut. So opposite to your view, and if the Federal Reserve doesn't cut, then the stock market will go down probably more. But I feel like even 6 months later, Aahan, I'm right about that. I still feel like your quantitative models will have caught up to me really quickly. So I feel like there's a lot of value that the work that you do is, even if you make predictions that are quote unquote wrong. I think being right is kind of cheap in this business. Like it's about making money, and that's
Yeah,
why
and I
clients pay you.
right, and I think it also boils down to, I think a lot of it does also boil down to like what is it that you're trying to do in markets? Like what are you trying to achieve, right? And so like it may sound like I have a lot of conviction that the economy is this, that, and whatnot. Right? Like it sounds like, oh yeah, like Ahan's a raging bull. He expects the economy to do this. He's long stocks and whatnot. But if you actually look at like our allocations across various programs, like they are conservative, and it all comes back to like that framework, right, of what is your expected return on your investment, and what is your expected risk. I think the expected return on being long equities is positive, and it's probably positive over like a 6 month period, but there's a considerable amount of vol that you have to take to get there. So what do? You have to have a small position long equities.
Mhm.
When it comes to bonds, what do I think? I think that you probably have positive expected returns over a short period of time, right? But possibly less vol in the near term. So you can have a little bit of a bigger position relative to what you have in the future. I think that when we look back, if the 6 month, 12-month views that I have play out, what we'll basically have is a situation where for now, we're basically going to have an even distribution between stocks and bonds. Like that's kind of how we're looking at it. We're like, okay, like we think the economy is fine, but at the same time, like markets don't think that at all. Like markets don't seem to be thinking that at all. Protect yourself. Like have modest diversification in that. Like so, our different implementations of this stuff are drawing down less than equities. So like that's the objective. And so now as we kind of come out of that, as I expect, if the economy recovers, start dropping your bonds because you're not going to get so I agree with you. Like you could get 2 cuts, like that's what they've guided to, right? But we already have 3 priced, and so they need to do more than is priced for us to get a meaningful rally in bonds. And I think that that's going to be the difficulty over the next year. If the economy is just fine, there's no need to go into 4+ cut.
Right. And I think that, yeah, if tariffs have no economic impact or very, very little economic impact, consider me a bull. I think you've converted me. I mean, the earnings growth in the SP 500 from the big Magnificent Seven stocks, other than Tesla, has been very high, and their multiples are now lower, and so that those stocks might be on sale. So I think we will see. But just like, I mean, Nvidia, it's down a lot, and based on current earnings, not forward earnings, but current earnings of like $3.56 a share based off current earnings. So if you just annualize it's what it earned last quarter, it's got a PE ratio of 32, which it's growing its earnings at 52%, and that growth rate will go down. But it seems like the U.S. stock market is not maybe as overvalued. I think the reason it's going down is because of tariffs. And if tariffs are a nothing burger, like you kind of imply, then yeah, stocks are a buy, but it will be volatile.
Yeah, and that's the way, like that's the way I feel it should be played. Like it depends on who you are as an investor too, right? Like if you are trading linear products, which are basically like, are you trading futures and are you trading spot equities? Like it makes sense to do this. Like if you're trading non-linear products, like you're trading options and whatnot, you have the opportunity to play for outlier moves much better, right? And so the juiciest bets are going to be like, oh yeah, like super outlier events, like right, like big equity market drawdown, that's a super outlier event and whatnot. But I think the way to manage risk through this entire thing is like, okay, equity markets and bond markets really seem to think that we're in a bad situation. I should take notice of that, right? But I shouldn't only take notice of that. And so what I should also do is I should take notice of what all the other macro data are telling me. What is employment data telling me? What is retail sales data telling me? What is industrial production? What is housing data? Like, what is all of this stuff telling me about the economy right now? And if you have some ability, even forecast that data, right? Like, there's very limited ability to actually forecast data well, but like within reason, what can you forecast? And when we come up with that picture, we just think that, hey, like, it probably makes sense to have not too much equity exposure, but we think that expected returns are going to be less than what you've had in the past, but they don't have to be like crash, recession, negative 40%. That's the view.
Yeah, if stocks were up like 30% last year, if they're only up 8% this year, that's still a good healthy return. And you might say, okay, relative to the volatility, cash performed better or something like that. But 8%, 12% return, yeah, that's still good. You can take
Yeah.
that and continue to compound that wealth. What do you think about inflation this year? Do you think inflation
Mhm.
is going down? And also, do you think real growth nominal growth is continuing to be very high, but do you think inflation will go down?
I think when it comes to inflation, there are basically like, let's be clear, like most inflation just stems from the good side. Okay. Like the good side of the economy dominates most inflation, and then it flows through to services over time. Right. So like the major changes in inflation start with goods inflation, and then over time, slowly the services side catches up. So like if you're trying to estimate what's going to happen to inflation, at any given interval, what you basically are looking at is you're looking at four big items to be able to understand like what inflation dynamics are. Those four items are food, energy, transport, and housing, right? Like those are, and those items basically determine what's going to happen to inflation over time. When we look at that picture, food and energy are pretty volatile and largely consistent with what happens to commodity prices. So, you can put those aside. Your energy component is basically just a nat gas component. Like that's all it really is. And that passes through relatively quickly as well, which is what is in almost every popular now cost measure. The
So
the how
what's the popular one in nowcast measure? What?
every single now cost measure is going to lean very heavily on oil and natural gas numbers to basically come up with what's happening to headline inflation. Like that's going to be embedded into any major now cost. When it comes to the other components, housing and transport, those are a little bit harder, but they are also extremely conditional upon activity. So if housing activity or transportation activity is strong or weak, over time, that nominal spending tends to bubble up into inflation in those sectors. As I've described, there seems to be a significant amount of weakness developing in the residential investment complex. Now, will that actually translate into deflationary numbers in the housing measures that the Fed uses and the BEA use and the BLS use? Because of the smoothing process applied, like it's going to be really slow moving, and the activity that we're seeing today is not that weak that it's going to result in really bad readings for housing. So what we're going to see in housing inflation is probably just a continual gradual slowing, which we've been seeing. And keep in mind, like everyone's been expecting a slowing in shelter CPI for 3 years, and it's just been slower than you wanted to. And a big part of this, okay, is if you go and read the footnotes of how the BA housing measures are constructed, there are these items in all macro data where there is something called judgmental trend, right? Like what judgmental trend is basically like the analyst who constructs the BA numbers receives all the raw data, and he has to construct the measure, and he constructs the measure based off whatever trend he thinks makes sense. So there's no way to mechanically time when the housing number is going to be this or that. Like it's all just guesses. And frankly, if you think about it, like a few years ago, or maybe 1 or 2 years ago, you had like real-time housing measures or whatever in negative, home price measures in negative, but for some reason the BEA kept printing positive, and everyone was like, okay, it's a lag, it's going to pass through. But then the real-time measures began to pop, right? They began to come up a little bit, and as a result, that judgmental trend was probably interpolated to be positive. And
So
so
the
like,
judgmental trend, they're making it, they're drawing a line through data, but it's real data. They're not like making up the data,
no,
right?
they're not making up the data,
Okay.
but what you have to understand is like, imagine an indicator, like a raw data series for home prices, right, goes into negative and then pops up to positive. Now I'm sitting over here and I say, hey, like, do I really want to put the negative in there? If I increase the look back, it's going to show the entire trend as positive. And so, like, there's no precise way to time exactly when a home price number is going to be anything, because there is judgment involved in terms of how they construct the series. So that, like, I just want people to understand that it's like really popular to be like, oh yeah, it's a 12-month lag, it's an 18-month. There's no fixed lag. It can be whatever. So what you want to do is you want to track what is happening to the actual, like, what is happening to the actual sector, and try to orient yourself accordingly. So what we think is, based on that orientations for ourselves, we think that you're probably going to have continued disinflation in the housing sector. The sector where we continue, and I think the first time we talked, I talked about this with you, and it's a point of pride. Only a nerd would pride themselves on being right about transportation inflation. But yeah, the place where you have the biggest dynamics that are inflationary are the transportation sector. And it's because COVID created a dearth of transportation inventories, automobile and motor vehicle inventories in the US economy. And so that particular component has been really, really resilient over the last few years. And now this is where tariffs become really important, right? Most automobiles in the United States are imported. Almost all of the consumed automobiles are imported. And so the place where you could see the most inflationary impact of tariffs is going to be in that automobile sector. And so, like, when we put together that picture of food, energy, housing, transport, we think, yeah, like, add up the headline number, probably like headed a little bit lower because housing's a really big weight. But the thing that's going to lead to surprises is probably going to be transport.
And then transport, there's a lag. If car prices go up, a few years later, car insurance goes up. Like we saw
Exactly.
that with, and car insurance has just been insane growth of premiums, and that is also something that people actually pay, so they notice it. It's not something that just kind of escapes their notice. Another thing we could go nerdy on is term premia, something that escapes my knowledge, but we'll have to do that when you get back on. I'm glad, Aahan, you are relative to, I guess, me and some people in the market, you are, I guess, a little more constructive on the market. You're certainly not a mega bull. You realize the volatility is there, but we've had, done a few bearish interviews recently. So I'm glad we've got you on for balance. If it's not clear to our audience, I've got a lot of respect for what you do. So people can find you on Twitter at Aahan Prometheus, and your company Prometheus Macro at Prometheus Macro. A reminder for everyone watching to subscribe and to our YouTube channel and to like the video, leave a comment. It really helps the algorithm. And of course, we are on Apple Podcasts, Spotify, and wherever else podcasts are found. We'll try and release this interview soon because we know things in markets are moving quickly. I'll be speaking later on to James Aitken, someone I've wanted to interview in a while. So that will likely go on live soon. And then, of course, next week is the Federal Reserve meeting. So I'll be speaking to Jim Bianco about that. And who knows, if the volatility is insane, maybe I'll do an intraday interview with someone in the volatility space, because I'm noticing some strange things there. A final, I guess my closing notes is that I've also been looking into tariffs from like the 1890s, because Aahan, you're so right. We have a sample size of very, very little. Like, no one has really been alive when tariffs have gone up in the United States. They went up literally during the Civil War. Abraham Lincoln was not a free trader at all. And then they stayed high until, I guess, like after World War One, and then Smoot-Hawley, they went back up. And then after World War Two, they went down. And then we've had a free trade era for 70 or 80 years. So no one really knows what's going on. And there are economic models about tariffs they will raise inflation or they will lower growth. So either way, they will lower real growth, i.e. inflation adjusted growth. But what do we know? What evidence do we have? So that's why I've been trying to go back to the 1890s. And I got to say, I looked at the sugar tariff in 1897, because there were 3 tariffs in the 1890s, not just one. And the price of sugar, it literally did exactly what the textbooks say it does. Of the price goes up and the price goes down in foreign markets because they have to price in the tariff. So I do think that the mainstream economic view that tariffs will cause economic disruption is probably right, but I'm open to being wrong. All right, that's I guess the end of my sermon. Thank you again, and until next time.
Take care, Jack. Thanks for having me.
Thank you. Just close the door.